Have you ever wondered what it would feel like to see tomorrow's market trend today? To know which customers might default before they miss a payment? Or to forecast your company's cash position with near precision instead of educated guesses? Most people think machine learning and financial forecasting is advanced science reserved for tech giants and hedge funds. But the truth is, it was created to solve a very practical problem. Traditional forecasting couldn't keep up with the speed, scale, and complexity of modern finance. To see this clearly, imagine something simple. Your phone predicts your monthly spending and warns you before you overspend. Without realizing it, that single feature already follows the core logic of machine learning, learning from past patterns to anticipate future outcomes. This is the Learning Studio, where we translate complex finance into intuition you can actually understand. What's really happening in that moment is straightforward. Algorithms analyze historical data, detect patterns humans might miss, test thousands of possibilities, and generate predictions based on probability rather than guesswork. That ability to learn from data and improve predictions over time is exactly what machine learning in finance means when explained formally. The same idea operates at a much larger scale every day. Banks use machine learning to forecast cash flows and assess credit risk. Instead of relying only on ratios and documents, models analyze income trends, spending behavior, repayment history, and economic signals to estimate default probability. Payment platforms like PayPal and Revolut use machine learning to predict fraud risks in real time, often stopping suspicious activity before customers even notice. In investment markets, machine learning models process interest rates, corporate filings, news sentiment, price movements, and global data simultaneously. This powers quantitative trading, volatility forecasting, and portfolio risk management. In corporate finance, companies use these models to predict sales, budgets, and capital needs months ahead, turning finance from reactive reporting into proactive strategy. This shift didn't happen by accident, and it wasn't driven by one company. It grew from decades of research in statistics, computing, and artificial intelligence, and was later accelerated by modern data availability and processing power. As datasets grew too large for humans to analyze alone, machine learning became the only way to extract insight at speed. But machine learning doesn't eliminate financial professionals. It elevates them. Models calculate probabilities, but humans decide what to trust, what to question, and how to act. Data quality, ethical judgment, and interpretation still matter. Markets can behave irrationally, and models can be biased if left unchecked. That's why the future belongs to finance professionals who understand both numbers and machines. Once you grasp this intuition, finance changes completely. It stops being about recording what already happened and becomes about preparing for what's coming next. Forecasting turns into foresight. Now that you understand the intuition behind machine learning in financial forecasting, the next natural step is to explore artificial intelligence in accounting, where automation, judgment, and ethics collide inside real financial systems. Stay curious, stay future ready, and continue the journey with the Learning Studio. I'll see you in the next episode.